Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Brookfield are trading higher today. The Toronto-based company posted record fourth quarter and full-year results, driven by strong fundraising and capital deployment. The asset management company also increased its quarterly dividend by 15%. The board of directors has approved the appointment of Connor Teskey as the new CEO. He will replace Bruce Flatt. And we are watching shares of Texas Instruments and Silicon Labs today. Texas Instruments will buy the chip firm for about $7.5 billion US. The deal will strengthen the company's exposure to several long-standing markets for chips, including home appliances, power, and industrial. Silicon Labs investors will receive upwards of $200 US for each share of the company's common stock. The transaction is expected to close in the first half of 2027. And shares of Advanced Micro Devices are falling sharply today. The chip maker's sales forecast underwhelmed investors, a sign that it's not making the AI inroads that some on Wall Street anticipated. AMD is contending with U.S. restrictions on what it can export to China, the world's biggest market for chips. U.S. President Donald Trump has moved to relax the curbs, but it has taken time to get those necessary licenses. And taking a quick check on the markets, TSX is down by 0.4% at the moment. We're watching that closely today. Also watching U.S. markets, which are relatively mixed when it comes to trading. They were. Now they're all down. The S&P 500 down by a full percentage point. The NASDAQ down by more than 2%. Challenging results, weak guidance, and a surprise CEO change. PayPal is at a crossroads after shares plunged more than 20% in just 2 days. So can the new CEO, former HP chief, revive one of the most iconic names from the dot-com era? Let's find out with Adam Frisch, research analyst at Evercore ISI. It's good to have you join us. Thanks so much.
Thanks, Lindsay.
So what do you think about everything we're hearing with PayPal right now? There's so many changes. Some are saying, this new CEO kind of maybe came sooner than expected. What's your thoughts?
I think he did come a little bit sooner than expected, but the prior CEO, Alex Chriss, was on the hot seat for a little while because execution was really, really poor since he got there a little under 2.5 years ago. Now, Enrique is taking over. He was chairman of the board, so all this happened under his watch as well. And if you think about what his track record is and where the pattern recognition is coming, it's more than likely he's going to try to break it up and sell it off. That's where we think the trends are heading, because yesterday on the earnings call, the management team was really just talking about sticking to the same strategy, but just trying to do it better. And that's really not working so well. So we think it's a very mixed up story right now. It's a bit of a mess. And investors, I think this was telegraphed for a little while, but I think the timing was probably a little bit surprising.
Interesting, because that's what I was going to ask you. Is this new CEO here to change things around, or is it just a patch, kind of a Band-Aid solution at the moment? But you say it's more about changing things, I guess, by maybe selling off parts of the company.
Well, he's not a payments guy, and this company needs a payments person, someone with experience both on the merchant side and on the consumer side to help turn it around. They really also need a technology person, because the platform is the main issue, and that's the cause and the root of all the problems that they're having, both with merchants and consumers. I think you categorized the company really well in your intro when you said this was a marquee name back in the dot-com era, and it was. They were a phenomenal brand, great platform, a huge lead ahead of everybody else. But they sacrificed that pole position through a bunch of poor strategy, bad execution, and poor technology, lots of technical debt. And that's why for companies like Apple with their Apple Pay, Android Pay, Shopify with their Shop Pay, firms like Revolut in Europe, buy now, pay later companies like Affirm, all surpassed PayPal because they had a superior consumer UX and better results for the merchant.
Right, because PayPal's core business has really stalled despite years of trying to actually turn around the company. What do you think the company's doing wrong? You just mentioned some of the things that PayPal doesn't really have compared to their competitors now.
If you think about the checkout experience with Apple Pay today, right? Whether you're online, on your phone, or in store, it's really easy. The UX is is really very convenient for consumers, double tapping the side of your phone. You can check out anywhere, it knows the address and everything else. You have your default payment mechanism in there as well. Just super, super easy. And very low fraud. So you're supplying in an Apple Pay, and you could also say Android Pay and Shop Pay and the others that I mentioned, are providing a real convenience for the user. And they're also supplying things like, because of multi-factor authentication, biometrics, they're supplying the merchant with lower fraud and higher approval rates. PayPal is charging more for those same services that the merchant is getting with others. Merchants, I think, are saying, why do we need PayPal? Is PayPal critical to our business? And the answer is, unfortunately for PayPal, the answer is no. Consumers have lots of alternatives to pay today. Again, things that are mechanisms that are more convenient and better for them. And the merchants are benefiting from that as well. So I think the underlying cause of all of PayPal's problems come from its technical platform, the lack of integration of prior acquisitions, the lack of really moving with the industry in terms of things like biometrics and MFA, which what I just mentioned, and that led to them being from a competitive, from a superior position in the competitive landscape to one that is completely inferior to others.
So if the company was to explore asset sales, what would that look like?
It's an interesting question. That's what everyone's asking. And given Enrique's background in terms of what he did at HP with separating that, I think that's kind of the logical scenario here, again, because he's not coming in as someone with incredible payments background or consumer marketing and skills that I think the company would need to really turn this around. And if they did decide to turn it around, it would be a multi-year attempt. This is not something that can happen in a quarter or two. So I think when you look at the breakup scenario, there are two very logical scenarios. There are two different parts of the business. The unbranded, which is the merchant-facing payment processing side of the company, that's an asset which is fine. It's decent. It's not as good as an Adyen or a Stripe, but it's certainly competitive with some of the legacy platforms out there that are doing e-commerce. We could see that going to a big processor, someone that wants access to that space, or maybe even private equity. And then the second piece of the business, which is the much more important piece of the business in terms of the percentage of profits, is the branded side, and that's the consumer-facing side with brands like PayPal, the checkout button, Venmo, buy now, pay later, etc. And we think Venmo and branded, core branded, the traditional button side, those could be separated into two as well. Private equity is always thrown out there because these entities are not growing, but they do generate quite a bit of cash. But I think that's also could be enticing for platforms that want a consumer asset base, consumer credentials for payments. And that's where I think Venmo is considered the better of the two assets there on the branded side.
So for investors that are listening to all this, seeing the guidance put out by PayPal and looking at PayPal's like long-term value, what should investors should they be considering, really, I guess?
Well, what we wrote in our research note yesterday to investors was we think it's kind of dead money. If this is going to be a turnaround, it's going to take several years, and you're not going to see any kind of acceleration or recovery in 26 for sure. And I would even doubt material improvement in 27, again, because this is a multi-year cycle. First, you have to upgrade the product, then you have to convince merchants to implement it, then you got to go convince consumers that they want to use it again. So this is going to take quite some time if they continue to go at it as an independent entity. If they break it up, the value is in the eye of the beholder. And, right now, it remains to be seen what kind of value potential acquirers would place on the assets. So our target price is $40. We think it's kind of dead money in that range over the next 12 months at least.
All right. We will leave it there. Adam Frisch, appreciate your time today. Thanks so much for joining us.
Thanks for having me. Take care.
Coming up, shares of Uber are trading lower today after the company posted a weaker profit outlook than expected. We'll get more on that right after the break. Stay with us. Shares of Uber are down today after the company gave a weak profit outlook. This comes as the transportation company is working to integrate autonomous vehicles into its ride-hailing segment. It also promoted one of its executives who is a strong proponent of driverless vehicles to CFO. So joining us now to break down the results is Brad Erickson, equity analyst at Internet at RBC Capital Markets. It's good to have you join us. Thanks so much.
Thanks for having me. Good to see you.
So what is driving these lower profits for Uber?
Yeah, I don't know that I focus so much on the lower profits. In this case, I think it was a little bit of just kind of street mismodeling. But yeah, they're making investments around 3 or 4 things for the out year, new types of rides, getting into suburbs, things like that. And that will require a little bit of investment. But you know, we're splitting hairs to some degree to say there's an issue on profit here. This company is still growing very fast, a lot of fixed cost leverage, plenty of profit expansion, and good capital return.
Yeah, and a lot of big news too, right? Like Uber's promoting one of their executives, as we mentioned at the top, who's a big proponent of driverless vehicles to be the new CFO. How do you think investors feel about this part of the announcement?
Yeah, we just published our note a little while ago and called it, we think the move or the transition in the CFO here is kind of strength to strength. The incoming CFO has a long history actually of dealing with investors. He kind of ran investor relations before he moved more into the finance department. So very well respected, did a great job in that role. And I would expect him to be kind of welcomed by the investment community with open arms.
Let's talk a little bit more about this driverless vehicles idea, because obviously it's becoming more popular. But I wonder, how does Uber balance like promoting companies like Waymo while also safeguarding its kind of long-term competitive position when it comes to driverless cars?
Yeah, it's a very, I'll admit, it's challenging to kind of understand the story of what's happening. I think you watch a company like Waymo coming into the market and clearly growing very fast, raising money, higher valuation, all that stuff. Tesla's coming into the market, and you say, gosh, logically, that's a competitive threat for Uber. And I think there's good logic to that. The reality is those players coming into the market, at least in Waymo's case, being material at this point, they are actually expanding the market, right? So Uber talked about this morning, that San Francisco is still accelerating. That makes no sense given that Waymo does have a meaningful portion of the market, let's say somewhere in the kind of 15 to 20% range. And yet clearly there is market expansion. I think longer term, the goal for Uber is to bring as many AV partners to market, not just Waymo, but there's dozens of other players trying to get to market. When they do that, that is what creates the moat. And Uber has the demand to fulfill the utilization, which makes it profitable. That's the key sort of impediment to all this is you can put a lot of cars on the road and run this service, and it's super cool because there's no driver in there. Problem is they're losing a lot of money still, and they have to figure that out.
But in the long run, you're saying if Uber was to venture more into the driverless vehicle space, that would benefit the company? Is that what you're saying?
Yeah, we think so. What I mean by bringing more partners to market and why that's so important is for right now, Waymo's at a stage of their kind of growth and evolution where it makes sense probably to handle more of the business, more of the distribution, and maybe not have as many third parties involved like an Uber. And so as time goes on, it really makes sense for Uber to work with as many partners out there as possible. Because in aggregate, those will ultimately likely compete away Waymo's distribution to some degree, or that's the thesis anyways. And then at some point, then the view would be that Waymo has to then come to Uber in greater size and suddenly work with them more. And then the bull case is fully in play. That's a longer term view, to be clear, but that's kind of how we think about it.
Got it. Okay, so Uber also saying that they're planning to launch robo-taxis in 10 different markets by the end of the year. Any headwinds that you're kind of anticipating with this release?
No, I think they work with a lot of good partners. They're trying to sort of, I like the fact that they're becoming kind of more open, trying to help investors meet some of these partners, learn about the technology. 10 was actually the prior target. They actually took that up this morning to as many as 15 partners, kind of half in the US, half outside the US by the end of the year. So, again, it's kind of narrative at this point. It's not going to hit the numbers, but certainly the fact that they're taking up those partnerships intra-period is a positive signal.
Okay, so 15. So you say half in the US, half elsewhere. I wonder if there's like a better market like the US, for example, to start doing this.
Anywhere is as good as anywhere, I would say. The key difference is kind of the insurance part of it, right? The U.S. being sort of we'll call it the most litigious country in the world, insurance costs are higher, and so there's going to be more of a microscope. And if you have an accident or hopefully not a fatality of some kind, there's going to be a lot of scrutiny, and it could actually push the whole industry backwards from a development and innovation standpoint. Outside the U.S., not to say that there would be any sort of less adverse view of, say, a fatality, for example, but we do think that the insurance sort of scrutiny that this market will face will be less. And so actually there's a lot of good development going on in parts of Europe and the Middle East that are looking to be very productive.
Interesting. Okay, a lot to watch for, but we'll leave it there for now. Brad Erickson, equity analyst at RBC Capital Markets. Appreciate your time today. Thanks so much.
Thanks for having me.
Coming up, Brookfield Asset Management has replaced its CEO after 2 decades in the role, and our next guest will break down what this means for the company's future. Stay with us. Brookfield Asset Management is moving ahead with its transition away from longtime CEO Bruce Flatt, announcing that Connor Teskey will step into the top job. Now, the news follows a fourth quarter that the company is calling its strongest since listing. To help us break down what this leadership shift means, we're joined by Ernest Wong, head of research at Baskin Wealth Management. It's good to have you join us. Thanks so much.
Thank you for having me.
So let's just look at Bruce Flatt's kind of tenure. What would you highlight as his defining achievements throughout his time as CEO?
Well, I think it's certainly been an outstanding tenure for Bruce Flatt. I think it's important to note that he is not stepping away from Brookfield completely. He will remain the CEO of Brookfield Corporation, which is the first-party capital business of Brookfield, while Connor Teskey will be the one who is taking over for Brookfield Asset Management, which is the one entity that is managing capital on behalf of investors, including Brookfield Corporation.
Okay, that's good to know as well. So when it comes to Connor Teskey taking over as CEO, though, should we expect him to continue what Bruce Flatt was doing, or is he going to make some changes, do you think, with the company?
I think it'll largely be business as usual. He's been at Brookfield since 2012. He previously led their renewables business. He was the one who kind of led the initiative for Brookfield to acquire Oaktree and move into the credit space. So I think he's very, very qualified and is simply going to continue Brookfield's strategy as they are currently executing.
Yeah, so as you mentioned, he was previously Brookfield's renewable power and transition business. He led that section of Brookfield. I wonder if you anticipate that segment kind of becoming a larger strategic priority with him as the CEO.
Yeah, so I think one of the interesting things about Brookfield compared to all of the other private equity players in the market is that generally Brookfield does focus more on these infrastructure, real asset type of strategies such as ports, utilities, pipelines, real estate, and certainly renewable energy. And these are assets that have long-term secular tailwinds where governments are increasingly looking for private capital to take over and invest in upgrades. And I think that's especially relevant in today's society where the main constraint, if you look at all the AI spend and the data centers that are coming on for AI, the shortage is electricity and renewable energy. And Brookfield is perfectly positioned to be a provider of energy to the data center industry.
And the company also, this leadership change has been part of a 4-year transition. I wonder what investors should expect in terms of any structural changes within the company too.
I don't expect any meaningful changes for the business. Brookfield has always been a very innovative company in terms of launching new strategies, finding ways to diversify the fundraising, whether it be from the insurance vertical, whether it be to extending to private wealth. whether it be to even raising money from the public affiliates that they have. And so I don't anticipate any change for that. I think one thing that Brookfield has kind of increasingly been doing is acquiring partner managers, taking small stakes in small asset managers that are kind of outside their core competency and provide them with scale to enter into adjacent markets. So I think we'll probably see some more of that as well.
And Brookfield also reporting, as I mentioned off the top there, what it called its strongest results since listing on Wednesday, which is pretty phenomenal to hear that. I mean, what factors do you think are driving that level of performance?
Yeah, I think that it was certainly a record year in terms of fundraising and in terms of earnings per share growth. And I think really this just speaks to the areas that Brookfield plays in, which is strong investor demand for infrastructure and good returns that are in excess of what you can earn in cash. And I think one thing to note is that an increasingly large amount of Brookfield's asset growth going forward is coming from the insurance vertical, which is not subject to the same challenges facing private equity fundraising that some of the other participants are seeing as well. And they have plenty of dry powder to take advantage of market distress if it plays out. And so I think all of this led to the confidence of the management to raise the dividend by 15% and announce a 10% share buyback as well.
Yeah, it's pretty amazing to hear that. I think you touched on this as well, but the firm raised a record-breaking $35 billion in the fourth quarter. I'm wondering what contributed to the surge in capital inflows there.
Well, I think it's just good execution in sales and launching products in asset segments that investors are interested in. So one thing that was called out was that they raised $5 billion for the AI infrastructure fund, which is building data centers that are underpinned by long-term contracts to hyperscalers and really playing on this theme of sovereign AI, where AI and data centers are becoming a strategic asset for countries as well. So I think we'll expect to see more of that. Even in some of the other areas such as real estate and infrastructure and renewable power, there's no shortage of interest in their products from investors as well. So they expect another year of good fundraising, and I think the shares are reasonably attractive at current prices.
Sounds pretty rosy right now. Like they're painting a rosy picture. Obviously, a lot of good news coming out today for this company. What challenges are the company facing ahead, though, do you think?
Well, I think the whole private equity industry is kind of facing a cloud of concerns about private credit exposures, about liquidity of the funds. And then yesterday, we saw a large sell-off in terms of how AI is going to impact software-related exposure in the portfolios of some of these companies. Now, again, Brookfield doesn't really play in these sectors. They called out specifically in the earnings call that they don't really have material exposure to software either in the equity or the debt side. And as we've seen from the fundraising results, certainly no issues in raising capital where others are struggling.
All right, we will leave it there. But Ernest Wong, head of research at Baskin Wealth Management, always appreciate your time and your insight. Thank you.
Thank you.
Up next, we'll take a look at how new fishing gear could reshape Canada's fishing industry. That's right after this. Shares of Eli Lilly are climbing today. The drug maker provided an upbeat sales forecast for the full year as demand for its weight loss drug continues to grow. The American company expects sales to grow as much as 27% in 2026. Lilly is in a stronger position than rival Novo Nordisk as its diabetes and obesity drugs have another decade of patent life. The company has also been more proactive in fighting competition. Toys R Us Canada is seeking creditor protection as it faces multiple lawsuits from unpaid suppliers and landlords. In the meantime, the retailer will evaluate its strategic alternatives and implement certain restructuring initiatives. This includes reducing its retail footprint to better position the company for today's retail environment. Toys R Us has also appointed Neil Taylor as Chief Restructuring Officer. And Pizza Hut plans to close 250 U.S. restaurants early this year as part of a program to improve marketing and technology. The announcement comes as its parent company, Yum Brands, continues its strategic review of the struggling pizza chain, including a possible sale. Fourth quarter results for Yum Brands were mixed. Same-store sales for Pizza Hut dropped, while Taco Bell and KFC both posted positive results. If we take a look at the TSX today, down by 0.2 percentage points right now, weighed down by losses in the base metals and technology sectors. U.S. stocks also weighed down today as tech stocks continue to sink. You can see the S&P 500, Dow Jones, and NASDAQ are all trading down at the moment. There is a new way to promote sustainable fish harvesting across Canada. It's called the Whale Safe Fishing Gear Strategy. The 5-year plan aims to implement ropeless fishing gear, allowing harvesters to fish while whales are present without harming them. So for more, I'm joined by Brett Gilchrist, Director of National Programs at Fisheries and Oceans Canada. It's good to have you join us today. Thanks so much.
Thank you.
So I guess first off, just paint a picture for people that maybe don't know, like how whales have been impacting fishing on the Atlantic and East Coast over the last couple of years.
Over the last several years, there's been a number of entanglements of endangered species like North Atlantic right whale. These are species on virtually the brink of extinction. And the way they get entangled is that they traverse an area, whether they're feeding or interacting with other whales or breeding or transiting, they get caught in vertical lines in fishing gear. And oftentimes, these vertical line entanglements lead to serious injury or death.
Yeah. So what is it about this ropeless fishing gear that reduces whale entanglements?
Ropeless fishing gear provides harvesters with the opportunity to set traps and pots, so for example, for lobster and crab, while removing that vertical line for the duration of that gear being in the water. So typically, you have a buoy at the surface, a vertical line in the water, and then a trap, so that the harvester can pull that gear. That trap, buoy, and line rest in the water for an amount of time, days, weeks. And when they arrive, they pull that gear out. During that time in the water, that's where the entanglement threat is for those baleen whales. Rope-on-demand gear allows the rope to rest with an uninflated buoy at the trap on the seafloor. There's no vertical line for the duration of when that trap is in the water. It only inflates and rises to the surface with that vertical line when harvesters arrive to retrieve the gear and the catch.
How does it inflate? Like, how do they inflate that buoy at the time when they need it to rise up to the surface?
Harvesters have digital tools on board the vessel, so they can locate the gear with those digital tools, and they can trigger that inflation device for the buoys to rise to the surface. And again, no interaction with whales for that. So it's a prevention tool for entanglements.
Oh, got it. Okay, that's very interesting. I mean, has there been trial runs? Is this already in use? Like, how have harvesters been? What's the feedback you've been getting from people who are using these tools?
Right. Because of the risk to North Atlantic right whales in their range, both in Canada and the U.S., harvesters in Canada and the U.S. have been leading the way in trialing this type of gear. And for example, in the Gulf of St. Lawrence, where right whale presence is increasing because of changes in water temperatures and food sources, fishers like snow crab have been trialing this and successfully sending product to market. It's not a requirement in Canadian fisheries yet because we have to make sure this gear is safe and effective to use, and it has to be reasonably cost effective for harvesters to make a living while using this new technology. But the innovation is increasing every day, and the application of the technology is increasing every day, and the Whale Safe Gear strategy will help us get there.
Is there a timeline or a hope at when this could actually be regulated and be in use?
The timeline for the Whale Safe Gear strategy is 5 years. The timeline for piloting rope on demand is in the next few years. Again, we're not going to require harvesters to use rope on demand if it's not safe for them to do so. There are a lot of things for us to work with harvesters and fisheries associations on the water, both Indigenous and non-Indigenous harvesters, to make sure rope on demand works. And we'll identify areas where it's most needed, for example, with the most co-occurrence with endangered whale species and those fisheries. And in areas where they don't co-occur or there isn't a high risk of entanglement, it wouldn't necessarily be needed.
You talked also about cost effective. You have to make sure that it's cost effective for harvesters. Obviously, like the fishing industry, huge on the east coast of Canada. How will this new gear, I'm not sure if there's any data out yet to show how it would affect like a yearly catch, for example.
I don't think there is data, you're correct, on how this would be operationalized in a fishery, because it doesn't really exist as a normal course of business for a fishery really anywhere in the world right now. It'll take time. And of course, as usage increases, the cost will come down for this type of gear. There are other less costly versions of whale safe gear, but some of them are more mitigation measures, as in low breaking strength fishing gear. The rope will break at a point where the whale can self-release, but this is a mitigation measure, requires the entanglement to occur, whereas that on-demand gear prevents the entanglement in the first place. So in the next 2 years, we'll be identifying areas that are most important for this kind of technology and working with harvesters to set up ways to pilot this gear.
Yeah, it's a great idea, like a great design. And I take your point that this gear is not actually in use yet, but I mean, how could it shape the future of fishing on the East Coast? Like, is there more gear like this that's coming out, do you think?
There is, and there's a lot of companies producing this kind of gear, both in Canada and the U.S., and it's an emerging industry in and of itself, the creation of this kind of gear. But of course, it's critical for fish harvesters to be able to fish when whales are present, ideally, because right now they have to move their gear in Canada in the East Coast if a right whale shows up. And that could be a constant challenge throughout the season and expensive for harvesters. So this technology would allow them to fish at the same time as whales are present. And as more harvesters adopt this, as more harvesters learn about that, the price point will come down for this expensive technology, and more participants creating this type of gear will be involved.
So in the long run, then, you'd see like more profitability for the fishing industry and for harvesters.
Absolutely. And of course, they get to fish. That's the bottom line, is they'll be able to fish rather than having to move their gear out of the way and move it back after the whales are gone. Right whales, for example, spend basically from the spring to the end of the fall in Canadian waters. So it gets quite complicated trying to find space for harvesters.
Okay, so interesting. Really appreciate your time today, Brett Gilchrist. I really learned a lot. Thank you.
Thank you.
That's about Brett Gilchrist, Director of National Programs, Fisheries and Oceans Canada. Coming up next, a new BMO survey reveals how Canadians are feeling about retirement. We'll unpack that right after the break. Stay with us. Welcome back. A new BMO survey on retirement reveals 2/3 of Canadians believe saving for retirement is harder for them than it was for their parents, and they don't see things improving. Younger Canadians especially see retirement planning as very challenging. So let's find out more. Joining me now is David Boyd in Calgary, a senior investment advisor and portfolio manager at BMO Nesbitt Burns. It's good to have you join us.
Thanks for having us, Lindsay. I appreciate it.
This is pretty concerning. What are the biggest factors here, do you think, in terms of people not feeling like they can save for retirement anymore?
Well, I think a lot of it, if you step back and look at savings, I mean, we talk on BNN all the time about inflation and cost of living going up and expenses drawing out of a household income. I think people are starting to feel that. And I think there's an anxiety around that, just around how do we actually save for retirement when we're paying for life, we're paying for everyday living. And then at the end of the day, surveys like this are saying they're finding it harder and harder being Canadians to save. So definitely a position I think people are finding themselves in. They probably didn't think they were in 5 or 10 years ago. And I think definitely something that needs to be dealt with on an individual basis.
And we'll talk about how that can be dealt with in a moment. But there was another thing that jumped out to me in this report that I found concerning. It says, despite these concerns, many Canadians are committed to supporting their children financially, even if it means sacrificing their own retirement security. So it sounds as though even people in an older age group maybe won't have that retirement savings that they expected to because they're helping out their children. Like, how concerning is that?
Yeah, the number is almost 50% when the survey was done. So I think if you look at those stats that you've talked about and then you back up from there, I think what becomes really important, and this was done by BMO in the survey, is you really need to have a plan. And this emphasizes more than it has ever that planning your future, planning your retirement, working with a professional, I believe is becoming more and more important than it was. And the survey shows that nearly 49% of people that deal with advisors are very happy. Almost 90% are happy with who they deal with. So when I see those numbers and we look at them from the bank's perspective, one of the key components is have a plan. And it sounds so simple, Lindsay, when we say it, but you don't go on vacation without a plan, you don't cook a recipe without a plan. So this just emphasizes the 101 of investing, which is have a plan in place, work with a professional that can help you provide clarity through that plan, and also have someone that holds you accountable, because we all know it's very easy to start next month. It's like going to the gym. Next month we'll really start. But now you look at it and think, this is important. Every month counts. So getting a pre-authorized plan in place, saving on a monthly basis, it doesn't matter what the number is. It's just getting that plan in place will make a huge difference down the road.
So if we're talking about strategies for different generations, like Gen Z, millennials, Gen X, boomers, is that the main strategy for all? Is have a plan, work with an advisor?
I think it's that, and I also think it's understanding what retirement looks like. When you mention those different generations, I believe that people define retirement in a different way. You have the boomers, as you said, 50% of them are looking to support their children somehow financially into retirement. That has to be factored in. The Gen Zs are different, the Gen Xs are different. So I do believe that you need someone to be working with you, and you need someone to help, because as the world gets busier for everybody, there's less time to set out the plan and less time to figure out what to do with your investments and what it looks like when you retire. So the survey shows us at BMO that one of the important things is having that plan and also sticking to it. So cost of living goes up, groceries go up. That's all part of life. But the old adage of paying yourself first in this type of situation really pays off down the road.
As I said at the beginning as well, a lot of people in the younger generations feel that they're facing challenges that maybe their parents didn't have to go through. Is that fair?
I think it's fair. I think the number was 77% on the survey. So I think it's fair, and I think the world's a lot different now with social media and a lot of younger generations wanting to experience life, we'll call it, at an earlier age. Those are all great things, but there's something that has to be factored in. And so when you look at that, you think life is wonderful, the world's a wonderful place to travel and experience, but at what cost is that? And so I believe that's where sitting with someone to lay out the plan, and not to be critiqued or tell you can't do something, but in fact, look at it with a good advisor to say, okay, how do we do this? Travel's really important to me in that example. How do I factor this in? Or going back to school is really important to me. How do I make sure that happens for my career going forward?
Okay, so it's less about like the world has changed and more about people's priorities have changed in different generations. Is that right? Like people want to travel more, they want to spend their money in different ways rather than save it?
Yeah, I wish I had a great quote to talk about how the world always changes but stays the same for you. But I do think in today's world, it's the same world. It's just, I believe, different priorities. And that's what we're seeing in the survey, is that different generations, the next generation is putting different priorities forward than, say, the boomers were, than the Gen Xs, than the Gen Zs. So I think a lot of that is still having fun in life, but also understanding that I need to put a little bit away every month, and I need to take care of myself and my family, so that when I do decide to retire, whenever that is, whatever it looks like, you have a nest egg in place that matches up to your plan when you're ready to go.
So when we're looking at these numbers and people feeling pretty like that it's quite dire in terms of saving for retirement, is there actually a silver lining?
I think there is. I mean, the survey showed definitely some concern around next generation saving and, harder saving than our parents. But if I look at the silver lining in it, I do believe firmly that having a plan in place, and it's never too late. I mean, you hear in our industry on the advisor side, is it too late to be sitting with someone? Should I just not save? And the answer is no. The answer is today's the day. So I believe the silver lining is sitting down with an advisor, developing a plan. Maybe there's sacrifices that have to be made along the way. Maybe there isn't. But I don't feel like that's a tomorrow thing. I feel like that's something you should deal with today. You should sit down, have a conversation, and then digest it with who you're with, whether it's your advisor or your spouse, and say, okay, is this something we're able to do? If not, go back and challenge the advisor as to maybe I can save less or a little bit more. What does that look like? So I see that as more the silver lining than the statistics that the survey produced.
Okay, some good advice. We will leave it there, but appreciate you joining us today. Thanks so much.
Thanks, Lindsay.
That is David Boyd, Senior Investment Advisor and Portfolio Manager at BMO Nesbitt Burns. Still ahead, we will take one last look at the markets before we go. The federal government is set to release a new auto strategy aimed at boosting Canadian-built vehicles, improving market access, and increasing electric vehicles on the road. CTV's Abigail Beeman has more in this report.
The auto strategy coming this week.
Bringing back incentives for buying EVs was not in the last budget, but heading into cabinet, ministers wouldn't rule it out as part of the new auto strategy.
We'll have more news on that to come.
Yep. So it sounds like you're bringing it back.
We'll have more news on that to come.
The auto strategy is being worked on, and these are different conversations we're having.
The industry minister also wouldn't say what will happen to the EV mandate, currently on pause. Sources tell CTV News the new strategy is expected Thursday. Melanie Joly said workers impacted by the loss of the third shift at the GM plant in Oshawa are at the core of new investments.
It's important because we know our auto workers are right now feeling the brunt of the U.S. unjustified and unjustifiable tariffs.
Industry experts say it's not just the uncertainty of American tariffs that hurt, but a lack of information about the deal to allow 49,000 Chinese EVs into the market, made during the Prime Minister's trip to Beijing.
We don't know what the parameters of that are, the guardrails around that are. So as opposed to more uncertainty, we need an auto strategy that provides certainty.
And industry hopes something to boost demand after a focus on supply.
The government have not done enough on the demand side. So on the demand side, we actually went backward.
Incentives are important because today the current regime is to mandate the production side of it and to punish producers who don't achieve a certain percentage.
Industry experts predict big changes coming to the EV mandate when the new auto strategy is rolled out, and are hoping it will allow industry to target Canadian demand after being hammered by White House tariffs.
And that was CTV's Abigail Beeman. Meanwhile, Manitoba's premier has visited the remote town of Churchill as conversations around possible port upgrades heat up. Ottawa is considering expansions through the port of Churchill, plus a project that would turn the facility into a year-round trade hub. Last night, the premier was in the hot seat hosting a town hall to hear what locals think about the project. And CTV's Alison Bamford has more.
On the shores of Hudson Bay, the people of Churchill, Manitoba take great pride in their land and the animals that live on it.
The amount of untouched land that we have here, it's something that we hold so precious to us.
And it's something precious they don't want to lose.
You want to pass something on today, tomorrow, and that will keep everybody going. And I don't want to have anything negative to the environment.
Concerns of wildlife, sustainability, and climate change echoed through this town hall, with discussions centered around the Port of Churchill Plus, a project that would upgrade the port and connect Western Canadian products to global markets.
We're not going to do the next round of investments or that big mega project in this region unless it works for people in this room.
But some still don't feel heard.
I have a lot of concerns because it's not will it impact the whales, it's how much is it going to impact the whales.
The premier believes a balance can be struck between trade expansion and marine conservation. Environmental groups agree it could happen provided care is taken.
A modest, responsible port in Churchill and a thriving beluga population can coexist because we've got proof of that.
Today, the province announced funding to explore the possibility of a national marine conservation area that would further protect Churchill's beluga population.
To grow Manitoba into an amazing future economy that we can all envision for ourselves. It's also about making sure that when we take one step in that direction, we're taking another step in the direction of the environment.
This is just one piece of the puzzle that needs to be sorted as talks continue around Churchill Plus. The province is also working with Ottawa's Major Projects Office to develop a report that the premier says would flesh out the numbers in order to make this project work. That report is expected in April. Alison Bamford, CTV News, Churchill, Manitoba.
Okay, let's take a quick check at the markets before we wrap things up here, starting with the TSX. It's down ever so slightly, 0.2%. If we take a look at some of the biggest winners and losers so far today on the TSX, First Service is the biggest gainer on the TSX today. It's seen the most gains since July after fourth quarter earnings beat estimates. Energy Fuels, meanwhile, the biggest lagger on the TSX, down more than 16% today, or it was. Now it's down just more than 15%. Take a very quick look at the U.S. markets as well before we wrap things up here. Mixed trading today. Software stocks dragging things down a bit. The Dow Jones, though, slightly up at the moment by 0.1%. S&P 500 and NASDAQ are both trading down. And that wraps up this edition of Trading Day. Thanks so much for watching.